Hi guys, welcome back to the channel. My name is Dave, and today we're talking option basics. So last week I started a brand new playlist, option basics. I'll link it everywhere. But that was part one. This is part two. So find that playlist if you want to get started, because I want to be a resource of choice when it comes to learning and understanding basic options. So what we did last week was we sold a put on Coca-Cola and we walked through that whole trade, and then we went and we sold that sucker. All right. Today I want to go back and I want to review that 1 week later. It's a 30-day option. We'll see where it stands. And then I want to go on to selling a call. So we're going to cover all four quadrants. They're in my mind at least. Selling puts and calls and buying puts and calls. Those are the four. Today's part two. We're going to fill them all out. There's going to be this playlist there for you if you want to learn this type of information. So that's what we're doing today. If that is what you're looking for, please stick around. Whoop. All right, so we're going to start where we left off last week. And we wrote out an option completely, right? And we picked ticker symbol KO, which is Coca-Cola. And the only reason I picked that is because everybody knows Coca-Cola. I didn't do an evaluation. It's just what I picked, so please understand that. But we went down through this option completely, right? We said sell to open one contract. It was a put option. We made all these decisions. A strike price of $50, an expiration out about 30 days. And for that, shows here premium $50, but in reality, when we checked it, it was about $35. So now I've updated that all and I put it onto a nice spreadsheet so we can start comparing these side by side, because we're going to start talking about selling covered calls as well as the put that we talked about. So let's go back and let's start looking at this selling a put that we did last week as a good starting point. All right, so ticker KO, and when we did it, it was at $56.02. This was last week on 10/3. And we said we're going to sell to open one contract, and it's a put. If I'm going too fast, let me know. But the idea here is we were selling to open one contract, and we're allowing someone else to put stock to us if it fell below a certain strike price, right? And when do we do this type of trade? When would we sell a put? We do this when we're kind of bullish or neutral on the stock, right? We think that the stock is going to go up in value. And therefore, we're going to sell something that's below this at a strike price because we don't think it's headed that direction. That's the general idea. Okay, and we're doing this because premium. We want to get some premium. We want to put our money to work. Okay, so we will collect premium because we're selling a contract. But we're also doing this because we like the valuation of this underlying security, which is Coca-Cola. So we picked a strike price that was way out of the money, away, pretty far away from $56. All the way down to 50 is where it would get put to us. That's about 12%, right? So Coca-Cola would have to drop 12% in order for it to get put to us. So for those two reasons, that's our why. We're going to collect some money, and we like Coca-Cola at $50 a share. We feel pretty good about buying Coca-Cola if it drops all the way to $50 a share after our evaluation process, which I said, we didn't really do one, but that's the idea behind selling a put contract and allowing somebody to put it to us. Because let's not forget, we've got a lot of money tied up in this, right? We've got $5,000 that we have sitting there in case we have to buy 100 shares, which is one contract. So hopefully that kind of starts pulling all that information together from last week. Now the expiration date we picked was 11/4. And when we went to look at this, we were gonna collect just $35. So not a huge premium, but it puts some money in our pocket, right? And I also say, there's a requirement here. We have to have that cash available to make this purchase if it does get assigned to us. And that collateral or investment that we would need to make would be $5,000. Now, where does that come from? That comes from the fact that one contract equals 100 shares, and we would have to buy it at a strike price of 50. So 50 times 100 equals 5,000. And that gives us something that's really important to understand too, which is the break-even point. So what's the break-even point? This is how much we actually would say is our basis now in the stock, because we're going to be buying it for $50 a share, but we collected $35 total. And on a per share basis, that's 0.35. So if you take 50 minus 0.35, we get a break even of $49.65. So now let's talk about this put option that we sold back here on 10/3 when the stock price was at $56, because now 10-7 after a kind of an up-down week. Monday and Tuesday were good, but Friday was a disaster. Coke stock fell to $54.51 this week. So just 1 week into our trade, and we've lost $1.50 in value on the stock price. But, options that we sell like this can always be closed out ourselves. So the option value was $35 when we sold it. But between now and the expiration date, that premium value is going to move around depending on where the stock is. Okay, so right now on 10-7, if we wanted to buy to close this, it would cost us about $44 to close out our contract. And I'll show you that here on Fidelity. So here's the setup, right? We sold to open this originally. Now we're going to buy to close and get out of our contract. So the quantities one, put, same expiration, same strike price, and you can see the bid and ask there. So the midpoint's about $44, so that's what I used. So if we wanted to get out of this right now, it would cost us $44. So flashback over here. So we sold to open, now we want to buy to close and get out of this contract. We can do that. It would cost us $44. So we made $35, now we have to spend $44 to get out of it, and altogether we have an option loss overall of $9 that we lost on this trade. So at this point with this option, I would do nothing. I would just let time roll, right? I'm not going to spend $44 and lose my $9. I would rather test my why that's up here, my thesis, which was I'm going to collect my $35 in premium. I'm going to still keep that. I'm not going to pay anything to close it at this point. And I'm going to be happy if it continues to fall and I end up getting 100 shares put to me at $50. I end up spending that $5,000. So that still holds true. At this point, I'm just going to let it roll. Now, if this was ever to drop to where this premium to close, it might be like $5. That's when I would consider maybe $10. That's when I would consider closing it out. Because if, let's say, there's 2 weeks left and I can only make $5, and I'm sitting there with a $5,000, collateral that's being held up to make $5 or $10, that's when when you might start thinking about, buying to close this option and moving that into another trade somewhere. So something to consider as we move forward. Now, let's talk a little bit about exercising options as well, since we're looking at this. So exercising an option. Now, when we sell this to open, we're giving the right but not the obligation to the person buying it for them to go exercise whatever the heck they want. Now, would they do it right now with the stock at $54.51? Certainly not. They're not going to put it to you at $50 right now where you can turn around and sell it for $54.51, making an extra $451. That just doesn't make any sense. It is important to understand that exercising simply means to follow the language of the contract, but ignore this expiration date. So exercising means use the strike price right now and assign that stock at 50. So when we are out of the money, like we are when we're at $54.51, they certainly will not exercise it. Instead, what they would do is they would sell the contract that they purchased on the open market. So as the buyer, they bought to open when we sold to open, right? So now they would want to sell to close. And from their vantage point, from their position, they would make $9 where we lost, right? So that's much better than losing 451. So the question that then comes up, and it always gets asked, is about exercising is when the stock price goes in the money. So let's imagine we wake up Monday morning to really bad news about Coke stock and it drops all the way down to $45 a share instead of this $54.51. Won't they exercise it immediately? And the answer is still no. So let's walk through this. At $45, the option would have $5 of real value between 50 and 45. And we call this intrinsic value. So if they exercise the option, they would get to essentially sell it at the strike price of 50 and buy it at 45, right? So they made $5, netting a $500 gain. But options, until expiration, always have time value along with intrinsic value. So if they sell to close the option instead, they will get the intrinsic value plus the time value of the option. So exercising would be worth less, and actually trading the option would be worth more. So now there is one major exception to this, and we'll talk through that in the future, but it involves dividends. So the idea here is when a dividend X date is in play and the value of that dividend exceeds that time value, which we'll figure out how to calculate that, it does make sense to exercise an option. So I imagine that discussion brought up some questions. If you do have one, please just ask down below. But now let's switch gears a little bit and let's write a covered call. So remember, last week we read out all the instructions to sell a put. Now I want to write out all the instructions to sell a call option. So we've determined after 1 week we were completely wrong on Coca-Cola, and we're going to start selling calls instead of puts. So let's set this up and let's get all of our stuff down. Let's write it all down again, just like we did last week. So again, Coca-Cola, but now the price is $54.51. It's 10-7 after the close in this case. And we are going to sell to open one contract. Because we're selling to open, I put -1, right? And now it's a call contract. So remember, a put allows someone to put stock to us, but a call contract allows them to call away our shares. So again, we'll talk more about this and what makes it a covered call here in a second. But our position on this and when we would do this is typically when we're kind of bearish to neutral on the stock. So we think, Coca-Cola is probably going to continue to go down in this market. And we're doing this, though, for the same reason. We want to collect a premium, and we like the value of selling the stock, in this case, at a strike price of $57 a share. We think that it's just not going to go up any higher than $57 a share. So we're happy to sell this call at that price. Now I picked the same expiration date as that put we sold. So it's out about 3 or 4 weeks from now. And for doing this, I get a premium right now of $65. I'll show you that trade in a little bit on Fidelity. So I get to put that in my pocket and walk away, go get my sushi dinner. Perfect. Now, important requirement number 1 when we sell the covered call is that we actually own the shares prior to selling the call. So remember when we sold that put? Well, we wanted to have cash available in case those shares got put to us and we had to buy them. Right? In that case, we needed $5,000 to buy 100 shares at 50. Well, now we need to buy 100 shares so that we can sell the call option. That's the order of operation, and that's really important as a covered call, right? We want to have the shares available, and then if they get them called away, it's okay. We already own the shares. So maybe you bought these 5 years ago. Maybe you bought them a year ago. Maybe you buy them right now and you sell the covered call. But either way, that's our order of operation. What we don't want to do is we don't want to sell a call option and not own the shares when we're just learning about options. If we did that, it would actually be called a naked call, and you might not even have the ability to do it in your brokerage account at this time. But if you could do it, let's just imagine potentially what could happen, especially if you're not familiar with options, right? It could go, who knows? You wake up tomorrow and Coca-Cola's gone to 80 because they came out with really great news. So suddenly you got to buy the 100 shares at 80 to cover your position, but you've already promised to sell them at a strike price of 57. That's a bad morning. That's not really what we're looking for when we're getting used to options and learning about the basics of options. So with call options, just remember the order of operations. Buy the shares, then sell to open the call option, and you'll be just fine as we get started with this. So in order to buy 100 shares of Coke at this current price, it would cost you $5,451. And that would give us a break even of $57.65. And this is another one that kind of gets people a little bit confused. So what we're comparing this to is, and where we get this number first of all, is that $57 plus the $65. On a per share basis, that's 65 cents. So that gives us $57.65. And if you compare that to not selling the call, our break even would be the same as just holding those shares at $57.65. And here's what that call option would look like on Fidelity. So here, in this case, it's a call option. We're selling to open one call with a November 4th expiration and a $57 strike. You can see the bid and the ask there, and the midpoint is right around 66 cents. So on 100 shares, we get about $65 is what I would estimate. But that's what it would look like. We would preview order, and we would sell this on the market. And while I say this is a bearish to neutral strategy, ultimately what you would like to have happen since you sold the $57 strike is you'd like to see the stock appreciate in value right up to near that strike price. So go from 54.51 up to 57 and then expire and give you full control over what you want to do next. Do you want to just keep the shares? Do you want to sell another call option at a higher strike and generate more income? There's lots of ways to use covered calls in this situation. So think about Coca-Cola. It pays a nice big dividend, right? So maybe you want to create a secondary dividend by selling a pretty far out of the money strike price option monthly and generate an extra little bit of dividend. Maybe you want to double your dividend value, create some extra income, but you want to keep those shares for as long as possible. Or maybe you think Coca-Cola is just fully valued at this point and you want to sell aggressively. You want to sell at the money. You want to get rid of these shares, but you want to generate as much income until it does get called away from you. There's lots of different ways to use covered calls. I will add that there are good times for both selling puts and for selling calls. For example, in 2022, the market's been on this huge decline, so selling covered calls has just added a lot of premium. I've added a lot of income by doing that this year. Unfortunately, the declines in the actual stocks have been much greater, but it has hedged the position a little bit and added some income to my portfolio. Previously, we've had some really nice bull markets we've been in previous to this year. And during that time, selling puts seems so simple going back, right? Sell a put, everything goes up, collect some premium. So there are times when both of them are going to work. So you need to be opportunistic. You got to kind of do a breakdown of this and make sure you understand what you're getting into and make sure it makes sense. Does the strike price make sense? Can I get the premium and the valuation that I want? If it all works out, well then that's a great way to use things like selling puts and covered calls. All right, so up to this point, we've talked a lot about writing or selling puts and calls, and I hope that at this point it starts making a little bit of sense to you. But if you have any questions on any of it, please ask down below. Unfortunately, that's only part of the equation. We have to go on the other side of the fence as well and talk about buying puts and calls so that we have a really good understanding of option basics. So that's what we're going to tackle in part 3. Now again, if you have any questions on anything that we've talked about so far, please ask down below. If you like this type of content, please like and subscribe, and we'll see you next time. Have a great night. Take care. Whoop.